All right, welcome to Chapter 3, Intermediate Accounting, the balance sheet and financial disclosures. Today I am rocking Glendale soccer. I promoting any and all kind of Glendale sports. If you guys haven't been able to go out to some sporting events this semester, you should try and give it a whirl. It might be fun. I been to a basketball game, had a pretty good time. Oops, I clicked the wrong one. Need to share the screen first. Hope your guys' day is going well. Would like your day to go well. I'm recording this still in the winter time, so it's a bit chilly. Got me a cup of hot chocolate with me to keep me warm. We'll see what happens. So, all right. Basically, what we're going to be doing is going a little bit more in depth into the balance sheet. Now on, the balance sheet is the classified balance sheet, and that's all we're going to worry about. All right. We're never going to go back to the non-classified. If you don't know what a classified balance sheet is, it's where we're breaking things out into different categories like current assets, current liabilities, property, plant, and equipment, long-term liabilities, etc. All right. Here's the consolidated balance sheet for Nike. We got our current assets there. We have our property, plant, and equipment. Please keep in mind though, too, sometimes your property, plant, and equipment will be broken out and show other like specific categories within that category. It's not always just going to lump them all together in one because they're very different classifications of assets in property, plant, equipment. You're going to depreciate building a lot different than you're going to depreciate equipment versus the fact that you don't depreciate land. So sometimes you'll break that out as well. We have operating leases. We don't talk about leases in accounting 112. They are covered, excuse me, in intermediate accounting. We do cover that in intermediate accounting 2, but not in intermediate accounting 1. Identifiable intangible assets, goodwill, deferred income taxes, etc. Okay, those are your balance sheets. Notice how they're broken out into current assets. And then we lump together all the long-term, or sometimes people like to call them long-lived assets, long-lived assets. I really hate that term. I don't know why, I just do. I think it goes to back to the day when I was studying for the CPA exam. And this her name was Cynthia, and she was obnoxious, and she would say it so weird, and then she'd start laughing afterwards. So maybe that's it. I don't know. Anyway, here's your liabilities, your long-term current liabilities, long-term debt, operating lease liabilities, deferred income taxes. You have your shareholders' equity. So you notice if you took my class in 111 and 112, we did balance sheets where they didn't really always total up the total liabilities here. Sometimes they would just lump a couple there, whatever, and then the equity, and then add it all up down here. So you can see we're kind of evolving into more of what we really do in the real world here. Stockholders' equity, retained earnings, all the time too. You see these ones where it says 6 and 3. Sorry, 6 and 3. I'm pointing up here with my mouse now. The emphasis here is that a lot of times these are in millions, and I can't remember. I'm going to go back a slide. Yeah, up here at the top it says it's in millions. Okay, so when it says 7,441 for cash and cash equivalents, that's billion. That's 7 billion, 7.4 billion. Okay, and then when we're looking over here at notes payable, that's 6 million. So got to make sure you understand the differences there. All right, as we did talk about in accounting 111 and 112, or in your financial accounting, you should have been exposed to different reasons why we have the balance sheet. And one of those is to evaluate our liquidity, our solvency, things like that. We're also going to be looking at other things like various costs, what our historical costs are, and things like that. And also, we're going to be looking at different accounts and what we do with them. So, oh yeah, here's the historical costs and things like that. And we're also going to do disclosures. I forgot, that's what I was going to say. 2 primary reasons the balance sheet does not equal the company's market value, because we record things at historical cost, and sometimes we have assets that aren't recorded because they have a 0 book value, but they have some fair market value. So for example, I could have a building that I've owned for 100 years, and it is in downtown New York, and it is worth millions of dollars, but I've already depreciated it all. So I have it on my books as 0, but my fair market value is a lot higher. So that's the example of that. Here are your classifications. Again, this should not be new information. You should know about the current assets, long-term assets, current liabilities, long-term liabilities, paid in capital, and retained earnings. Okay. Current assets. Bottom line is you're gonna use this within the company's accounting cycle or operating cycle. I mean, usually a year. Very seldom are there other companies that are longer than that, but there are some I've learned just recently, in fact. But current liabilities, we're going to be operating, and the idea is we're going to use these to make sales or make money or revenues within the accounting, or I keep saying accounting, within the operating cycle of the company. 1 year is typically what we're looking. So when we say it's a current liability or a current asset, it's because we're going to use it within a year. So what are some of those current assets? You can read them up here. The big one is, of course, is cash, and cash equivalents is something that we're starting to introduce to you. It's not always just physical cash you have in your bank account, but things that are considered highly liquid. Accounts receivable, inventory, etc., prepaid expenses. Here's what the balance sheet looks like for Nike as of 2022, 2023, showing the current assets. Pretty self-explanatory, I hope. Shows what it was at the beginning of the year and the ending of the year. Pretty straightforward. Now, what are our cash equivalents? So cash equivalents are anything that can be considered very, very liquid. In this case, we're defining it in this book as maturity dates no longer than 3 months from the date of purchase. Okay. If we get something that we can easily turn into cash, great. That's what it is. We could sell bank drafts, cashier's checks, money orders. All these are cash equivalents. Okay. Commercial paper, money market funds, treasury bills. All of these are considered cash equivalents. Then let's talk about short-term investments. Short-term investments are typically something that we are going to sell or reach maturity within the next 12 months. Yeah, it says, I'm sorry, it threw me off and it says whichever is longer. Next 12 months are the operating cycle. Okay, we're going to go, unless I say otherwise, we're assuming that our operating cycle is 12 months. So within the operating cycle or the 12-month period, short-term investment is something that we plan to sell or will come to maturity within that 12-month period or that operating cycle. Accounts receivable are also called trade receivables. Basically, you're owed money based on your trade. It's interchangeable. There's some words that some people just can't let go. Bottom line is you are going to have money owed to you by your customers. That's what a trade receivable essentially is. And it says non-trade receivables result from loans by the bank or individuals or other entities. Okay. Non-trade. I was like totally threw me off. I don't know why they're talking about that right here. So whatever. We'll just move on. Inventory, basically anything in finished goods, work in process, and raw materials. You should have been exposed to this in managerial accounting. If you are concurrently enrolled in this for some reason, that is a rare exception that some people are able to do. But if that is the case, anything in the costs associated with finished goods, work in process, and raw materials inventory are all included in your inventory. And keep in mind how hard it is to sell. One thing, I'm going to go back like 5 slides really quick, back to the current assets here. Notice how it goes from most liquid to least liquid, okay? Notice prepaid expenses are not very liquid. It's because trying to get money, if you prepay your utilities, let's say, trying to get that money out of the cold dead hand of the electric company or the water company, good luck, okay? The only way you're getting that money back is if you just stop paying and use it, or you close your account. Either one, that's about the only way you're going to get that money back if you prepaid it. That's why prepaid expenses are considered very highly illiquid or not liquid at all. Current or inventories are more liquid because ideally you will spend that money or you will sell those items. Prepaid expenses is basically just covering what I just said. You prepaid something and all you have to do, you just have to wait the time. Keep in mind there can be prepaid expenses that are not current because you prepaid 2 years. So all of a sudden now you have half of it is prepaid current, other could have to be prepaid long-term. Here are your long-term assets, investments, operating lease assets, other long-term assets. You got it. Property, plant, equipment, tangibles. Again, all this should be pretty much review when we're going to get into disclosures, maybe some of this other Sorry, I had to go back. Some of these other things like goodwill and stuff like that, we really haven't covered. It's okay. We will be getting into some of that. Investments, though, are going to be covered in intermediate accounting too. But a lot of the stuff we're going to talk about again, especially property, plant, and equipment, inventories, things like that, cash and cash equivalents. Okay, investments. You can have long-term and short-term investments, but you can also have the current portion of long-term investments. It's like I guess if you have a portfolio, maybe that would work, but I'm actually thinking of liabilities, so disregard that. Property, plant, equipment. Again, this should be very familiar to what you're doing here. All those examples, we've covered that in your other financial accounting classes. Operating lease agreements are basically a way you can rent something, but because you need this stuff for the production of your company, you have to do certain tests as to whether or not it's considered an operating lease or a capitalized asset. And so I can't remember if this course we get into that. I think we do. We're not going to cover it all right this second, but the bottom line is there is a test. I think it's a 4-point test. At least, yeah, I think it's a 4-point test that we're going to cover to find out if we're going to count this as an operating lease or a capitalized asset. And then you have your intangibles, again, copyrights, trademarks, patents. Goodwill's a big one. Goodwill's basically the amount, not basically, it is the amount of money you overpaid for another company. It's the goodwill. You're giving them extra money so that they'll sell to you, kind of a thing. This is the idea there. And you don't. Some of these you're going to test for impairment. Others you're going to amortize over the life of the asset. Now, I'm not an expert on how long these are. You know, you get these. I knew a patent lawyer, and he knew all the patents, copyrights, how long each one of them lasts. I could ask him any one of those, and boom, 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 he had it. I don't have that. No, I don't memorize that stuff because it can also change. In fact, Disney Corporation lobbied Congress for a while there, got an extension on one of their trademarks. Or is it trademark copyright? I can't remember. I think it was a copyright. Steamboat Willie was set to expire in like 2020, and they managed to get it extended, and I think they had it until 2024 or something like that. But now you can use the image of Steamboat Willie however you want. So, but you know, I think you probably all are looking up right now what the heck is Steamboat Willie. But bottom line is that's how that works. Other long-term assets could be just anything. It's a catch-all. We just throw whatever's left. Liabilities, here you go again. You have the current, you have the long-term, other operating lease liabilities, deferred income taxes, basically prepaid not prepaid, things that you have received, or gosh dang it, sorry, we've paid it already, or no, we've received it, the bills and stuff like that, we haven't paid it. Sorry, my brain is a little scattered right now. I apologize. I'm blaming the cold. Current liabilities also, again, it's the stuff we're going to be using or having to pay off within a 12-month period, a 1 year, or the operating cycle, again, whichever is longer. You got your examples here. We're going to go through each one of them. Accounts payable. This is basically stuff you owe to your merchants, your suppliers, okay? Notes payable, stuff that you're usually going to owe the bank with some interest involved there. You got deferred revenues. These are when you receive money in advance of work. So like a gift card, you sell a gift card, you can't recognize that revenue until it's redeemed. This says or expires. There's some jurisdictions that won't let it expire. I think California is one of them. Accrued liabilities, they're obligations that we've received, but we have not paid yet, and we will do so later. Talking, usually about utilities and salaries are kind of the one that really comes to mind on there, but there's some other examples as well. Current maturities of long-term debt. Now think about this: when you have a car, if you have a car payment or a house payment, it's long-term. Car 3 to 5, or God help you if you have a 7 or 10-year car loan. I guess there's talk about doing a 10-year car loan. God, I would never do that. I hate 7-year car loans, but I get it. They keep jacking up the cost, and we're not making any much more money, so it's hard to make those payments. But either way, you are going to have within the next 12 months 12 payments for your car. Same thing with your house. Then you're going to have a series of years after that that are the long-term part, okay, because they're beyond 12 months. So the current portion is what you're paying in the next 12 months, and then the long term is what's beyond that 12 months. That's what we're talking here. So we have the current portion of long-term debt is what we call it. And you know, this book, I guess, calls it current maturities. It really doesn't matter what you call it. I mean, I sometimes wonder if we just kind of try to come up with clever names because we're like, we want to be like lawyers or something. I don't know, but current maturities, we just want to use cool language. Bottom line is it's current portion of long-term debt. Then you have other long-term liabilities. It could be anything that you owe within the next 12 or beyond 12 months. Could be some kind of lawsuit that is going to settle in 12 months, more than 12 months, and you know you're going to be paying it or something. I mean, we don't get rid of the definition of a liability just because we're now in intermediate accounting. Remember, we don't always have to know the exact amount, but if we don't know certain things, we will need to disclose that in the notes to the financial statements. Okay, then you have your shareholders' equity. And then, you know, if you want to take assets minus liabilities, you could do that, or just look at what you have in your paid in capital, retained earnings, and other additional paid in capital. And I mean, your primary paid in capital and retained earnings, these are really your two biggest areas of equity. Okay, and I'll kind of identify here on this stockholders equity section. Common stock and additional paid in capital is your paid in capital. Your retained earnings and your accumulated other comprehensive income is like your retained earnings. So it's just kind of how we classify it, but you know, we have different accounts for each one. So we don't necessarily group them that way. We just, that's what we consider them. It's those two main groups. Okay, this is talking about the differences in international financial reporting standards. I don't care. Annual report and disclosures. We need to have our financial statements, our notes to the financial statements, an auditor's review of our financial statements and financial information, management's discussion analysis on internal control and procedures, management taking ownership and responsibility for the financial statements, all kinds of stuff. Now, if you took my 112 class when we did that, looking at the company and doing the analysis of that company, you were very familiar with their annual report, and you looked around, you saw their financial statements, their disclosures, the notes to the financial statement, the auditor's report, etc. So hopefully you had a chance to do that. Here we have our disclosure notes. For our first note is typically the note that identifies our significant accounting policies and practices. We're going to give all this information about all this information that we have on our balance sheet and other financial statements. It's basically outlining every single thing so that there is no question as to what we're doing with our company. Because if all you do is just see inventory and you're like, well, inventory went up or down, because you have to do comparative financial statements. Doesn't matter. We got to look at these and figure out, you know, hey, why did this? What's the deal? How do you use FIFO, LIFO weighted average, specific identification method? Tell us more about your receivables, what method you use a percentage of sales, percentage of account receivable. There's so much information in those notes. You get more information from the notes than you actually do from the balance, from the financial statements. So if you can get good at reading and looking through those notes to the financial statements, you are going to be highly employed and highly sought after for auditing because you live in those notes to the financial statements. If there's anything that is going to happen after the financial statements are reported that the company is aware of and is significant, you have to include that in the financial statements, the notes to the financial statements. You need to say, hey, we plan on issuing a ton of more debt or a ton more equity. Or we're buying this other business. We're going to have this thing going on. We're selling off our assets. All kinds of different things. Hey, we're planning on cutting off a segment of our company. We're going to spin it off. So many things that if you don't say that, is that going to change my mind as to whether or not I'm going to go and buy some stock in the company if I find out later on, 3 months later, you were going to spin off one of the main legs of the company and I wouldn't have any access to that. I mean, that's maybe why I wanted to join the company or buy the stock of the company. Yeah, so those kinds of things has to be disclosed. And then all the noteworthy things that are good, bad, or indifferent. So if the company allows certain class of employees to take out loans, if there are any kind of, hey, we let the CEO buy one of our cards for $5 or things like that, we have to disclose that information and we have to be very transparent. So we got to know all that information. Basically, if it, again, the full disclosure principle, we have to acknowledge it. If we think it could sway anybody's decision or could be construed or looked at as nefarious, we probably should disclose it. It's better to disclose something and not really need to than to not do it and find out later you should have, and now you're hosed. Okay. Errors and fraud, as long as it is material, you have to disclose it. Now, even if they are unintentional, if you just made mistakes but were significant, you have to disclose it. Blatant illegal acts like bribes, kickbacks, illegal contributions to political candidates, and other violations of the law have to be disclosed. Okay. Typically, people are already going to know that happened. Okay. More than likely, an auditor is not going to go in there and discover major kickbacks and bribes to the political candidates. Okay. It's because a whistleblower came through some other time. The auditors came in when they were doing their thing. They looked at that and then they said, yep, it sure did. It happened. And you just have to disclose that it happened. But more than likely, anybody who's paying attention knew it happened. Okay. Management's discussion and analysis is basically management's responsibility to take care of and take ownership of the financial statements. Back before the Sarbanes-Oxley Act happened, management would pass the buck on to the auditors. The auditors would deny, hey, we're just giving you reasonable assurance. I mean, there's all kinds of things that, nobody wants to take accountability of it and stuff like that. But now the management has to do it. The management has to make a statement on the results of operations. I mean, all the stuff that's listed here. They also have to make a comment on the internal controls of the company, any things that they're planning to do, significant events, trends, things that they think are kind of happening that they're not sure about. A good one would be AI. How would a company disclose the uncertainties related to AI in their business? I mean, from the perspective of an investor, that might be something that would actually draw someone to that company as opposed to maybe an employee who may not want to get a job and then find out they're getting laid off in 6 months from AI. So things that need to be disclosed there. And then here's again some more information. I already covered this when I was talking about that other slide. Compensation to all the top directors and executives have to be disclosed. Any environmental, social, and governance disclosures. It's really interesting because I remember watching a boring interview from this guy who so I'm politically neutral. I don't even like whatever, but he was saying, so like there's a section of the world that believes in climate change and there's some that don't. Okay. And by climate change, I mean adverse climate change that is going to have catastrophic results in the world. Okay. So whether you believe it or not is I'm not going there. What I'm saying is that if it was real, these companies are supposed to disclose that. Okay. And none of them are. In the prospectus, nobody is saying we are saying, hey, we have this situation that is bad with carbon emissions and we believe it's going to cause this problem. So kind of makes you wonder, well, is it the company's just hiding it or is it really overinflated? I'll let you decide that. Again, I'm not trying to get political, but that is something that if there is a concern, they should be bringing up. Now, here comes to the auditor's report. The auditor's report, we are going to give various kinds of reports. The 4 basic reports are unqualified. What that means, if I remember correctly, because they've changed these words around. Well, actually, we just get into it. Let me just get into. These are the 4 types. It's basically unqualified as a clean. So it's qualified means there's something not right about it. Okay, there's just some more concern about it or whatever if it's not completely unqualified. It used to be called. Let me go back. It used to be an unqualified. Oh no, it was something else. They changed the wording because it made it sound like when you gave them a good report, it was bad. And I can't remember what they called it, but I'll see if I can find it somewhere. Bottom line is the auditor is going to give a report and say, hey, we're good, hey, we're bad, whatever, but we're going to say when it's unqualified, it means that when we look through everything, there was nothing that gave us an opinion that there were problems that would be concerning to people who would look at these financial statements. Please do keep in mind, though, an auditor is not saying it is 100% accurate. Auditors take samples and they look at it and they compare it and they project that onto the population. So is it possible that an auditor reviews an account and finds that it was missing something later on, but not during the audit, and only to find out that like the whole thing they looked at, everything looked squeaky clean. But then when they audited the next year, they found it and they're like, oh crap, this has been going on for 3 years. Yeah, it's possible. It's not supposed to say 100% assurity. It's to give you reasonable, what is it called? Reasonable assurance that the financial statements are presented fairly and without material misstatement, I think is the words that I'm trying to say. All right. So what if there's just something that's wrong, but it's not major? We can say it's unqualified with an explanatory paragraph. In other words, hey, everything looked good except this. There was one thing that we like, not too good. All right, we got a problem here. And that's all this is. It's just another paragraph you add to the report and say, yeah, this is what they're going to need to work on. Maybe it could be, hey, they're talking about getting taken over by another company. That's a going concern issue. Material misstatement. Hey, we found something that was pretty bad, but they've already, put in the implementations to fix it. We'll be watching it in the next audit or something like that. Just stuff like that. Lack of consistency. Something major would be if they switched from FIFO to LIFO and didn't bother to tell anybody. Okay. Or they didn't present you need to go back 5 years to present financial statements for the past 5 years when you change a major accounting practice like that. Not a cheap thing to do. Not a cheap thing to do at all. Then you have some other audit reports that you're going to focus on the nonconformity with general accepting accounting principles. Basically, anything that says, hey, they diverted from GAAP. They did not do what GAAP said they should do. Sometimes that's okay if you have a good reason for it. If you don't. But anyway, in these situations, you might get a qualified opinion. That's the not good one. I'm sorry. Yeah, qualified is the not good one. Adverse means these people are committing fraud. Bottom line is, I don't know that an auditor would ever give an adverse opinion. They probably would just quit the engagement. I don't know. I could be wrong. A disclaimer of an opinion means that, hey, things were so bad, we couldn't even give you an opinion. It was that bad. So bottom line is, any of these three situations, you're basically sunk. Your company's sunk. So you need to make sure that your ducks are in a row, your ducks are in line, whatever, so that you don't hit these if you're running a company. There are plenty of risks with a company, okay? Will the company be able to pay its obligations? If not, that's a default risk, or it's a risk at all, no matter what. There's always a chance any company could not end up paying their obligations. In fact, I worked for a company, it was private, so it wasn't stock, but owner, it's a home building company, and the home crisis hit. Guy just stopped paying his bills. This is obviously bad. So there's always that risk depending on the market. I mean, think about COVID. How many companies have the default risk there? And the government attempted to bail them out, but I'm sure there's a lot of companies that didn't make it. So operational risk, things could happen that would cause it to not really be able to earn profits. Think about, I'm trying to think of something good. I mean, just think about streaming. Okay? You guys are growing up with streaming, whereas I grew up with CDs and DVDs, right? I mean, look at Operation Risk. I mean, Hastings and all these other CD rental, DVD rental companies that were out there. I mean, they were killing it, right? And then all of a sudden, Netflix joins up. Hey, we have this thing that's called the internet. Just watch a movie here. Just order this disc. We'll send it to you, and then now it's streaming online. Operational risk, man. These guys didn't see it coming. All of a sudden, boom, they were out of business. I mean, they felt like a rock coming down from the heavens. All right. We got to do some analysis on our financial statements. Again, accounting 112, we hit these. We have the comparative financial statements. We need to have those in order to be able to do these analyses. Horizontal, we are looking about how the company has performed over time. So we're going to compare, let's say if we're looking at, Nike's been the example, so we'll stick with that. So Nike has, let's say we're looking at their financial statements and they have in 2022, X amount in cash. We're going to just see how that goes. We're going to compare 2023, 24, 25 back to 2022. I'm recording this in 2026. So we wouldn't have 2026 data yet. So that's why I stopped there. Vertical analysis is you're going to be looking at something compared to the total. So it would be like I'm looking at current assets and comparing it to total assets. I'm looking at even just specifically cash or things like that and comparing it to the total assets. Same thing with the liabilities and equity and things like that. Then the ratio analysis are the things we're really going to be focusing on. Is we're going to be looking at all the different ratios and how to calculate them. And it's going to tell us something, whether the things are if the company is liquid, if the company is solvent, if the company is profitable, things like that. We'll get into those specifically. Liquidity ratios, current ratio, and we'll be getting into each one of these, so I'm not going to go over the formulas here. And I don't ever remember or expect you guys to remember most of these formulas. Please jot these down. I give you guys a sheet of paper for your notes for your exams. So make sure if you're not good with formulas either, please make sure that you jot these down because it's important. But anyway, these are going to tell us whether or not a company can provide for its short-term obligations. And I think this is a good time to give you your word for this video. It's kind of almost a little bit over halfway. The word is candelabra. Okay, it's like a type of, let's see if I have one here. I should have one. I don't. It's like a candlestick, right? Except it's got usually like 3 or 2 at least, but 3 candlesticks on one thing. Candelabra, CANDELABRA. Charlie, Alpha, November, Delta, Echo, Lima, Alpha, Bravo, Romeo, Alpha. Candelabra. Please put that word in the video, and you can get your points. Sometime soon, I'm going to be doing a thing where you're actually going to be answering questions during this. So maybe you don't have to do that. If that's the case, great. But that might be a few semesters. All right. Let's move on. Current ratio, we calculate that by taking current assets, dividing it by current liabilities. So if we're looking at Nike, we took the current assets and divided by current liabilities. Now, when we see this, now again, you can calculate these numbers and that's great. Anybody can. I get Excel to do it for me all the time. You need to be able to interpret this. And by being able to interpret this, you're going to be able to understand what these ratios tell you. So as we look at current ratio, what this says is that for our current assets, we have 2.72 current assets for each $1 of liabilities. Now that may sound great, but we're going to get into some other ones where we're going to look at to see if this is actually really good or not. All right. Another one is working capital. This is what the amount of basic current assets that we have that we can use to keep working in our company, just the current assets that we can have, hopefully, more liquid ones so that we can produce the revenues we're looking for. So we take current assets minus current liabilities. That gives us working capital. All right, the acid test or quick ratio. All right, this is a little bit different. Okay, we're going to eliminate basically the most illiquid things out of the current assets, but we're leaving our current liability alone. Okay, so the numerator is going to exclude inventories, prepaid items, and any restricted cash. Restricted cash is going to be something that, hey, maybe legal, we have to restrict this cash for some legal reason. Bottom line is we can't have those in there. Everything else that's a current asset can go in here. So no inventories, prepaid items, or restricted cash. These are considered, according to the slide, as quick assets or just the assets that if we really needed to crank out some payments, this is what we're really pulling from. We're not going to really be able to sell our inventories any faster. So we got to just make sure that. So when we look at this, if we're over 1 on this one, we're in a good situation. We're in a really good situation. So as we look at Nike, it says that we are 1.6 with the acid test ratio. That's really good. But notice how big it was from, well, I'm going to go to the next. I think it's the comparison. Yeah. So we look at the industry average and we see that Nike's doing better than the industry average. But look at Nike by itself. We dropped almost 1 whole point from the current ratio to the acid test ratio because when the chips are down, if we really had to pay off our current liabilities with our current assets, we're not going to be able to really do that with our inventory or our prepaids, right? Remember, we talked about how those are really hard to turn into cash. So that 1.6 is more, I don't say more better. It's about to do it. It's a better read than just the current ratio. Current ratio is great. It's easy to calculate. The acid test ratio gives us more information. It's much better. All right, solvency. We're going to look at debt to equity ratio and then times interest earned ratio here. So our debt to equity ratio, right? All we're going to do is take our total liabilities and divide it by our stockholders' equity or shareholders' equity. That's it. Super easy, barely an inconvenience. So our example with Nike is our debt to equity ratio is going to be 1.68. That means for every dollar of debt, for every $1.68 of debt we have $1 of equity. So that could be good. That could be bad. It really depends on your company's weighted average cost of capital structure, or your capital structure, not weighted average cost. Your capital structure. Some people like, or the industry itself needs more debt. Sometimes the industry doesn't. But when we look at this industry, it looks like the industry average has it at 1.05. That's more of a healthy situation. But think about this. Who's not going to loan money to Nike? Nike, it would take a catastrophic event for Nike to go anywhere. It's not going anywhere. It's like Disney, it's like Amazon. These companies, unless something just huge happens, they're not going anywhere. So with that, Nike's debt to equity ratio may be a little more tolerable than, say, maybe, I don't want to say Under Armour, because I really like Under Armour more. What about Adidas? Adidas is a decent company. I haven't heard anything bad about it, but maybe they're not as strong as actually, I'd probably say they aren't. So if something happens to Adidas, they might need to have a little less debt so that they can attract more investors and things like that. So, again, it just depends. All right. Times interest earned ratio. All we're looking at here is to find out how much we're turning over, we're getting interest. Okay. How much are we getting interest? So that our creditors, are more protected. The creditors really care about this. So we're going to take our net income plus our interest expense plus our income taxes. We're going to divide that by our interest expense. In fact, most income statements are going to cover this for us. Our income statements are going to give us our net income before interest and taxes on that income statement. So we don't even have to really add those back in there. A lot of times it's going to be on the income statement. So then you just take that and divide it by interest expense. So let's look at Nike's. Nike's times interest earned ratio is 22.31. I would say that just higher the number is probably good, because you're going to be able to cover your interest pretty easy with that. So anyway, sorry. I will full transparency. I'm not too strong in the times interest earned ratio. I haven't dealt with that a whole lot, but to me, it seems like this would be, it would be pretty decent, I guess. So anyway, sorry, I'm kind of got garbled there and everything, but bottom line is, higher the number, the better off you're going to be able to pay your interest expense. What happened to my? There we go. Okay, risk and profitability. All right, you're going to have a relationship there. More debt can mean higher return on shareholders' equity, but it also can mean that you have too much debt and you're not going to be able to pay your debts off. You're going to have a solvency issue. So you have risk and profitability. You got to balance that. All right, so that's kind of what I'm talking about. Whether or not you're going to have more debt to equity or more equity to debt. This is a good example of kind of showing what happens when you increase your debt, because now your interest expense increases and all of a sudden that ratio plummets. You just have to look at things and you have to kind of figure out what, as far as a company establishes, is the capitalization mix that they want. Maybe they want it bigger, maybe they want it smaller. It just really depends. And there's standard guidance on it. It's not like, you're shooting from the hip or anything, but you just one of those things that you have to kind of be aware, because if you don't have a lot of debt, you have a ton of equity, you're primed for someone to try to come over and buy your stock and take you over, because then they want to use that equity for their stuff. So all right, segment information. So when we do these companies and we look at these companies and evaluate them, and we look at Disney Corporation as a good example. They have a lot of different segments. Okay, you have your I can't remember right. They have the parks segment. They have the film and entertainment segment. They have, actually, I can't even remember, just all. They have like 4 or 5. Oh, they have Disney, Pixar now, and they have ESPN. All these different segments or companies within their basket. Each one of those segments are going to report information which is rolled up into the corporation, the Disney Corporation. So when you're looking at companies, you may want to look and see, is there some segment that's dragging down the group, or something else? Look and see, just maybe make sure. But for the most part, you're going to get summary data from the segments. You're not going to get specifics unless you have someone from the inside, at which point that's insider trading, you get in trouble. Here's your information that's often shown. Let's look at this next slide here. Abbott Laboratories is an example. So you have the pharmaceutical, the nutritional, diagnostic, medical devices, and then the other. These are all your different segments. This shows their net income or net sales. Operating earnings, assets, just various information. It's just giving you the rundown of this stuff. It's kind of just a general information. We are in the appendix, by the way. I'm just kind of going through this because this is good information, but it's not necessarily stuff we're going to see a whole lot of. Yeah, maybe not this much so much. Yeah, I'm not getting into the yeah. Okay, we're done. All right. Well, I gave you that word. Hopefully you got it and picked it up. If not, you're gonna have to watch it again. Just kidding. Anyways, have a good one, you guys. Chapter 3. Well, again, most of it's again review, and I hope that hopefully a lot of it at least sounds familiar. Let me know if you have any questions. We'll see you in the homework. Talk to you guys later.